Okay, I'm going to go ahead and get started. Hi, everyone. Welcome. You can always enable subtitles by clicking more on your Zoom page if you would like live transcription. My name is Andrea Marson. I'm the Equal Justice Works Fellow at Maryland Volunteer Lawyer Service. Welcome to our third Thursday training for this month of March. This training will have two parts. First, our very own Amy Hennon, who is the Director of Advocacy and Financial Stabilization here at MVLS, will talk about how American policy choices impact inequities in the credit system. And then Sue Rogan, who we are delighted to have joining us, is with the CASH campaign, which stands for Creating Assets, Savings, and Hope. She is their Director of Strategic Partnerships and also is an accredited financial counselor. Sue will be getting into more of the nuts and bolts of building good credit and how to improve it after adverse life events like bankruptcy or a debt that's been pursued by the court. So thank you so much, both of you, for presenting today. We're going to get started with Amy.
Thank you, Andrea. So I want to sort of start off by kind of laying some just basic historical perspectives here about how it is that when we look at credit and we break that down by race, that there are significant disparities that exist, and what are the foundations of that. And this, this is not, we're not going to go back to the beginning of US history, but we're going to go back to the late 1800s. And when we're talking about the various components that lead to housing inequities, and I'll get into why the housing inequities wind up leading into the credit-related issues. But when we talk about compromise, when we talk about Jim Crow laws, when we talk about sharecropping, and when we talk about residential segregation, that these are some of the foundations that result in disparities in the housing market, and disparities in home ownership, and segregation of cities. Baltimore it plays a prominent role in this. People that are familiar with Baltimore know about the black butterfly and the white L. And that really comes from, that actually comes from not just de facto, but de jure segregation as well. But laws being placed on the books about who gets to live where. And then thinking also about the ways in which these policies coming from the federal government and sort of other practices that are happening, the impact that they have. Redlining is the practice by which the federal government literally drew red lines around Black neighborhoods and said that lending could not occur in those neighborhoods. It meant that the ability to expand home ownership did not exist for plenty of Black residents. Because we know that homes tend to be that significant store of family wealth. They tend to be the kind of one large asset that most people have in their lifetime. And this really kept folks from being able to buy homes in Black neighborhoods, keeping Black people living in those neighborhoods from becoming homeowners. There are all kinds of other sort of policies and practices that also contributed to these things, including blockbusting, including contract buying. The contract buying piece, the people thought that they were, this is often a kind of rent to own sort of situation, which still exists today in Maryland and in Baltimore, but was a particularly predatory practice when it was invented. And things like this, things like sharecropping actually and tend to flow into some of the things that we see today, including the existence of ground rent, where the person owns generally the entirety of their home, but there is this theoretical concept of the ground that it is on that is owned by somebody else. And so this, all fun stuff, we kind of keep moving along, and we think more about some of these other ways that these issues are institutionalized. Kind of fast forwarding quite a bit in US history, we get to the Fair Housing Act, which is an attempt to do away with some of those redlining practices, but we eventually wound up seeing reverse redlining, which was a really significant practice, particularly in Baltimore, where banks were especially targeting their more expensive, more fee-heavy loans directly into those Black neighborhoods. And so if you laid out a map of where subprime loans were occurring, those were much more likely to be in Black neighborhoods. And you see these situations with these sort of predatory loans, these predatory practices that wind up stripping equity out of these neighborhoods, and the impact that they have on someone's ability to build wealth over their lifetime. So we're gonna kind of tie that into banking deserts, which if you have easy access to a bank, if you have easy access to a place to deposit your money, a place to maybe engage with a banker and learn more about, getting a home loan, you have a better likelihood of getting access to lower cost financial products than you do if you live in a banking desert. And what we see, the correlation there is that if you live in a banking desert, you are far more likely to have high cost, expensive products that are marketed to you, same way that we see with reverse redlining, that these expensive and predatory practices are much more likely to occur in these Black neighborhoods when they don't have access to banking that is affordable, where there are affordable products that are marketed to them. We see that also with debt collection practices, that when if you lay out a map where the address of the home of the person who has a debt collection case filed against them, this is far more likely to be in a Black neighborhood, and all of this information comes from some ProPublica research that was previously done, that looked at debt differences that exist between white families and Black families, and also kind of the debt collection practices that happen specifically in Black communities. So, thinking a little bit more about consumer banking, and specifically about banking deserts and what happens when there is a banking desert. You wind up with these kind of two pieces where you have the regulated, subsidized lenders that are offering much more affordable products, and then you have the unregulated or far less regulated practices. Certainly we see payday loans, title loans, which are not necessarily always happening in there. Those have been sort of mostly outlawed in Maryland. People still do get access to them, but we also see things like pawn shops really proliferating in these communities, and it's because where banking deserts exist, you see so many of these these unregulated, these much more costly and much more predatory industries pop up, and so this results also in a disparity between folks that are banked and versus folks that are either unbanked, meaning that they don't have a financial institution that they're associated with at all, or they're underbanked, meaning that they are not getting access to enough of the products that they would potentially need in order to be able to sort of live their financial life. We also see a disparity in account fees that are paid by Black customers compared to white customers. And when you break down, certainly banks that are, where communities are paying more for, especially some of those really high cost banking fees, those often tend to accumulate in Black communities. So again, same thing. When we have these banking deserts, there are obviously these negative impacts. This is the same thing about the 100 of this in the previous screen, the $190 more for per checking account that people are paying in fees. And then if we think about just debt collection practices, where people are paying more for their debts, again, this comes from a it's called Debt in America. There's an interactive map of all of the sort of debt collection that's happening. And this is the disparity that exists even in medical debt. Obviously, we're all making use of we all make use of we all have hospital bills and other things, but this is how things break down for white communities versus communities of color. All right, so MVLS runs a consumer protection clinic, and we see this bear out in the work that we do every week. When we break down, what is the average person that comes to our clinic? What is the average person we see on the debt collection docket in Baltimore City? She's an African-American woman who is earning less than half of the Maryland median income. The average composite person is in her 40s. She doesn't have a college degree, and she's caring for at least either a parent or a child in her home. 92% of our clients at the debt collection clinic in Baltimore City are Black. And the average of these cases is $700 or less. And so we see in the work that we do that everything that I've just talked about bears out in terms of who has access to what and who's being pursued for debt collection cases. So how does this relate to credit? Well, there are a bunch of things that make up your credit score. But one of the things that is in fact really important is, of course, your credit mix. Obviously your credit history and your payment history are important, and then amounts that are owed. These are all the sort of things that make up your credit. But if you think about, who is going to be the people with credit scores over 700, those are going to be folks that are going to have a really good mix of credit. They're going to have long and good payment histories. They're going to have had access to better, higher quality, cheaper banking products, credit cards with low fees. They're going to have had access to auto loans with low fees, low interest rates, and all of this is cyclical because it ties in that if you have a lower credit score, you wind up with these higher cost options that are more expensive for you to have because it is expensive in this country to be poor. But also that but then the products that are then marketed to you are going to be more expensive because you have a lower credit score, and you have the lower credit score because you don't have access to the things that would help you build a better credit score over time. And thus, there's been a movement in the last couple of years to change the things that are accounted on credit worthiness. Before, when we were talking about both that mix of credit, one of the things that really contributes to people having a good credit score is often if in that mix of credit, they have a mortgage. Well, everything that we just talked about with the history of the United States and the ways that segregation has happened, redlining, reverse redlining, all of that stuff ties into why it is that you might see people having, again, the difference that occurs here in people that have a credit score over 700 versus under 700, and the racial disparity that exists there, that can absolutely have something to do with people having less access to these good quality financial products, but also less access to housing, less access to home ownership, and thus having that reduced credit score. So there are these new ideas about kind of how to help folks build credit over time, and that can include asking your rent to be added on to something where you positively paying your rent over time results in you potentially getting a better score. This is something that exists in Maryland. There was a law that changed a couple of years ago that allowed people to add the rent and utilities to be able to help them demonstrate better credit history. I will say that my understanding is that this is not always necessarily something people are told about, and so they don't necessarily know that this is something that they can do to help improve their credit score, is demonstrate that they have this lengthy credit history, they have this lengthy history of paying these bills on time. And so it is definitely upon those of us that know about this to tell people that this is something that they can potentially do in order to demonstrate their credit worthiness. This is not something that's available in every state, but it is. But in some ways, there are still options for folks, even in other states, to potentially ask reasonable landlords to add their on-time rent payments to their credit history. And this can, in fact, be very useful for folks that need other ways to demonstrate that they're credit worthy. So with all of these ideas sort of vaguely in play about what it means to be a person in the United States, have access to good banking products, have access to home ownership, and how all of those things impact your credit, we want to just sort of think about that and the disparities that exist, especially among race. We want to think about that when we're working with folks that don't necessarily have great credit, and they're working to improve it. And so now I'm going to turn things over to Sue, who is going to talk more specifically about things that can be done, kind of go from there. So I'm going to stop sharing my screen and let Sue take over.
Thanks, Amy. Andrea and Amy, thank you so much for the opportunity to be here today. We are huge fans and supporters of MVLS. I know that we send a lot of people your way, so it's always great to be able to partner with you and do these kind of educational webinars together. So thanks everyone for spending time with us today. And again, my name is Sue Rogan. I'm the Director of Strategic Partnerships with the Cash Campaign of Maryland. Hopefully you already know about the Cash Campaign's free tax preparation services for families who earn under $58,000 a year, and hopefully you're referring people to us. I just want to make sure you know about our other services and really just highlight two of them. You may know about our financial education webinars on the Cash Academy site, but we also have financial coaching that may be a good option for a lot of people that you're working with. This is where someone can work one-on-one with a financial coach virtually anytime that's convenient with them for any length of time that they're willing to work with them. So they help them to set the goals, make the steps to reach those goals, and then celebrate the progress along the way. So that's something that's available. There is no income eligibility requirement for this. So please let people know about this service, as well as our Bank on Maryland program, which provides certified bank accounts. Basically, these are checking savings accounts that have some guardrails on them. You may have seen and experienced people who've had a lot of difficulties with overdraft fees in the past. So with these accounts, there is no overdraft allowed. So people cannot get into that difficulty again. So please feel free to look on our website and refer people to these accounts if they need a safe checking or savings account. So I want to really jump into the topic for today, which is how do we help people rebuild credit after some hiccups, whether it's that bankruptcy or the loan they may have defaulted on. What are some ways to rebuild credit? And one of the highlights I want to mention is that sometimes people really focus in on their credit score and take that sort of as a measure of their own self-worth. And I think it's important to talk to people about this is just one aspect of how you've handled money. And if it's gone in difficulties in the past, that's fine. That's absolutely understandable. People can actually rebuild a very healthy credit score, even from bankruptcy, within 2 years, or even sometimes a little bit less. So just make sure we're giving people that hope that it can absolutely get better. So some of the data that I'm going to share with you comes from the Credit Builders Alliance. And if you don't know them, they're a national nonprofit that are really the leaders in credit as an asset. So they've given us the training and the background to be able to deliver some of this, and some of which I'm sharing with you today comes from them. And one of the things that they really found is that some of the best practices for strong credit scores are to keep it active. Occasionally, you may find someone who gets a credit card, after these difficult times, we're going to talk about different options for them, and says, you know what, I'm really concerned about getting a credit card debt again because I've been there, I've done it, don't want to do it again. But now I have this card, I'm just going to stick it in a drawer and never use it. Unfortunately, that isn't as helpful in building a credit score as using it. So it will show up on the credit report as an active account, But if there isn't data flowing in terms of the consumer using it, paying it off, keeping it low, it actually isn't really helping to build a healthier score as they could. So we need to keep it active, ideally trying to have a mix of at least 3 active installment and revolving credit trade lines, and always paying on time. As you saw from Amy's graphic there, what makes up a score, the biggest piece of it is payment history. So pay on time, pay on time, pay on time, that's critical. And then keeping it low, making sure that we're talking to people about keeping the lower debt balances on these credit cards or revolving lines of credit, so that number one, we want to pay it off every month and not have to pay interest to the credit card company, but keeping lower balances, as we'll talk about in just a minute, actually really helps keep the healthier credit score than having a higher balance does. And then keeping it up, trying to have at least 6 months of credit history and, again, activity on those credit accounts on the report at any given time. So let's talk about how we get the good stuff going for the people that we're working with. So taking some time to think about what are the credit building products that are most helpful to them, and what are they ready for and eligible for? Again, trying to make sure we're thinking through and talking about getting back into credit products after maybe having had some difficulties with them. What are some things that might be different strategies to build in for the use of them this time? So if we're going to help somebody get into perhaps a secured credit card, let's talk about what the strategy is going to be for using it. I had one young man who actually put $14.63 of gas in his car every day on his credit card, every month on his credit card. I'm not really sure what the $14.63 was about. That was a number that had a lot of meaning to him, but that's what he did every single month. He paid it off every single month, and he was actually building that strategy of, I don't put anything other than this on here because I don't want to get back into credit card debt. And then lastly, is there potential with this product for ongoing credit building? How do we make sure that it's sustainable for the person? So one of the actually really most successful strategies for helping someone to rebuild credit is a secured credit card. So this is actually a bank or financial institution's credit card that's backed by the money that the person puts in it. So the collateral is the security deposit. The terms, generally they're going to have an annual fee involved with this card. It should be reporting to all 3 credit reporting bureaus. And here's a listing of where you can find ones to be able to compare. So basically the scenario behind this card is the person saves up the amount that's required by the financial institution, $250 or $300. They go to the financial institution, they give them that money, it gets put into account that they don't touch, the bank doesn't touch. It's basically sort of an escrow-ish account. Then that person gets the actual card, they pay the fee for the card, somewhere between $35 and $45. They use the card that has that credit limit of $250 or $300, whatever it is. There's no options of going over. That's what makes it secured, and that's what makes financial institutions willing to issue these cards to people that may not have a healthy credit score, because they have that security right there in the financial institution. It's an actual physical card. People use it in the exact same way they would use any other card, getting the gas, getting groceries, whatever it is, ideally paying it off every single month, so that data is flowing to the credit reporting bureaus on how they are using credit. And it is a very good way to actually build or rebuild credit. Now, there are some notes of concern and things to think about when you're talking to people about getting a secured credit card. Make sure they know they have to save up the amount of money first. They're going to have to pay the fee, but be careful on where they're choosing the card. Some cards, particularly ones that I see advertised in social media, they often are only able to be used at a certain website. And the information and the products that are being sold in that website are very expensive. It's not something that they would be purchasing normally. So that isn't as helpful as a card that can be used anywhere. So we don't want any limits on where that card can be used. And then Amy, do you want to share the information you were talking about, cards that are attached to checking accounts and how that can be a concern?
Yeah. So, and this is, the thing is that about this particular piece. So, data breaches are definitely going to occur everywhere. Every company that you interact with is probably going to experience a data breach at some point. I know that my social security number is out there in the universe. But for instance, Capital One has one of the most common, secured cards. And instead of having to send the deposit directly to the bank, directly to the credit card company, they would just say, as long as you maintain a bank account that's got this amount in it, we'll give you the secured card. The really unfortunate and tricky thing was that when Capital One had a data breach, most people who had a Capital One credit card, you know, their credit card was put at their social security number was put at risk. But everybody who had one of these secured cards where it was also tied to their bank account had both their social security number and their bank account information lost. And so it's just that in many ways that might be a valuable that might be a more valuable service for the clients that we're working with, to be able to have that bank account that is tied to this, and this might be a better option for them. But it's also important just to be thinking about like all the ways in which all of our information is at risk, and if and just to kind of keep an eye on things. And if we hear that there's a data breach, it's time to start making some changes, potentially, you know, changing account numbers, moving banks, other choices.
Thank you. So you're absolutely right. It's not a matter of if, it's a matter of when information gets taken. So again, a secured credit card is a very effective, very easier than some other things in order to help people rebuild credit. But there just are some things that people need to do to protect themselves when they're getting one. So another thing is a credit builder loan. And these were developed specifically for helping people to actually increase their credit. So these are often installment loans. So they're going to be equal amounts of money that's paid every single month, which helps with, you know, the spending plan or the budgeting. They're often offered by credit unions or nonprofit financial institutions, again, with the sole purpose of helping to build credit. So again, they have a collateral, which means the loan funds that the person takes out actually sit in a savings account in that institution. They're often between a year, 2 years. They generally are reporting at least one credit reporting bureau. We like to ask and see if they can report to more. Here's a list of some that are here in Maryland. This is not exhaustive. It seems like different financial institutions are doing these all the time. So it's something to tell people to think about, is looking for a credit builder loan, maybe in addition to that secured credit card. So we're working towards getting those 3 mixes of installment and revolving credit lines on the credit report. So there's some other loans called special purpose loans. So these are designed to have a specific need for capital. So I need money for something, and it helps build credit at the exact same time. So sometimes there are microloans that organizations offer, small business loans, housing stability loans, preferably generally by different nonprofits, and immigration loans. The picture is one I wanted to show you that CASA of Maryland has in order to help people be able to apply and get their immigration status. They loan them the specific amount of money that is needed for it. It gets repaid, and then that actually gets reported to the credit reporting agency.
So I'll just share one other kind of specific kind of loan, a special purpose loan that exists that may actually be specially for that maybe if you're working with somebody who's emerging from bankruptcy. There are these they're actually written into a particular code, a particular section of the bankruptcy code. And they are these loans that are for people that are emerging from bankruptcy that need to get a car. They are very expensive. They have a lot of fees associated with them. They're not necessarily great products. And when somebody's thinking about going through bankruptcy, it's important to talk about like what their auto transport options are going to be, because you don't necessarily want to have somebody where there's very few options. But this option is one that exists, and is a special purpose loan, but it's definitely a situation where, you know, when you get on the other side of it, you want to be able to potentially refinance that car into a lower cost option. So
always looking at that, right? How do you reduce your cost for it? For sure. Thank you. All right, so Amy talked a little bit about rent reporting, and I just wanted to touch on this a little bit more and let you know that the older FICO models, which FICO is the biggest producer and seller of credit scores, and the older ones are still the ones that are most popular. Those older FICO models actually do not include any kind of rental reporting at this moment, but the newer ones do. FICO 9, 10, and the Vantage score, which is the competitor of FICO, they do actually incorporate rent reporting. So how, as Amy was saying, how do people get that done? So maybe the landlord, the best scenario, right, is that the landlord agrees this is a good thing to do for their tenants, and they do it, but some don't. There are different places I want to make sure I let you know about and understand the pros and cons to, where the consumer themselves can make sure that their rent is being reported. So there are fee-based rental reporting services. I'm not recommending it, but I wanted to show you an example of this one that's out there. There's a lot of them out there. And again, NerdWallet has a really good article that compares the pros and cons and gives the cost of all of them. Some of them can really get expensive. And the thought to think about right away is that worth, is that money that's coming out of the person's pocket, is that worth what the increase in the score may or may not be, versus using a different product like the secured credit card or a credit builder loan. So just some things to think about as you're talking with people. So how much is this going to cost? What credit reporting bureaus do they report to? How soon is that payment reported? Is it right away? Is it 6 months later? And importantly, how to cancel that service. Because at some point, if the person chooses to use this type of service and spend this money on this product, they will have a credit score that they're comfortable with and they want to stop paying this money. So how is it to cancel? And what are really the reviews of that kind of company? So I just want to also point out that there has been an explosion in fintech products. And fintech products are sort of defined as any sort of technology that's using to help people either manage their own finances, be able to pay bills, or what we're talking about is building credit. So there are a lot of competitors out there now that are saying to consumers, use us, we can help you build your credit. It's going to be fast, it's going to be easy, right? They're throwing these really nice words out there that make people think like, oh, sure, I want to do that. For example, one of them is the Experian Boost. So I don't know if you've heard about this, but I know a lot of people are using it. And I was teaching a class one time where a class participant went and did it right on her phone right there and then. So Experian has developed this process of where someone can tie their checking account to Experian. Experian, I'm going to use the word trolls. That may or may not be the best accurate word, but they go through their checking account to find on-time payments of utilities and rent. And that data is put then into the database and increases the score. And the person who did it during the class I was teaching increased her score by 15 points right there and right then. So it's getting a lot of media attention. I see it on TV, I see it social media. So people are hearing about it. And I just want to point out that when you're talking with someone who says they're thinking about doing it, just point out that they are then tying their checking account to Experian. And back to Amy's point about minimizing our risk, think about Experian's data loss a couple of years ago and how many people were affected by that, 140 million. So it can be a concern and something we should point out that, are you comfortable in giving that information to this company and how secure are they going to keep it? So some of the fintech product that I want to talk to you about are the ways to build credit. Again, not recommending this one, just pointing out this is one example. Chime is a fintech company. They are not a bank. They got in trouble for calling themselves a bank. They are no longer calling themselves a bank. What they are is a fintech company who partners with a bank to offer financial products like a checking account, savings account. They now have one with credit. So they're out there advertising that they can help consumers build their credit in a very quick and easy way. They're not the only one. There's lots of others. But I just want to make sure we're thinking about, as people are mentioning to us that they're using these type of fintech products, asking the people, is this company insured? Are the funds protected? You know, what's going to happen if the company loses money? What will they do with the consumer data? And how do they handle complaints? You may have seen in the news these different headlines here. So Cash App, you've probably seen a lot of people using this because it's a convenient way to get money loaded on and then be able to pay either bills or be able to pay between people, such as Venmo too. And Zelle is the fintech product that takes away that the Cash App and Venmo, which are separate companies that link between individuals and their checking accounts. Zelle links between financial institutions. So between PNC and Bank of America, that goes directly from one financial institution to the other by using Zelle. The other way, it goes through Venmo, it goes into the Venmo app, then it goes to the different financial institution that the members have. But they have generated thousands of complaints because consumers are losing their money through either of these apps and they're not getting them back. So it's a big concern. The regulation and the laws around these fintech products is still very much evolving and very muddy and very confusing as to who has jurisdiction over these type of companies. So it's just something to point out to people that as they may be thinking of using fintech products, to think through the questions that are listed here before they do so. And so some things to think about when we're helping people decide which product to help build their credit. Is it affordable? And is it affordable actually on the very most difficult of months with their income? Many people that we're working with, their income is not consistent every single month. It goes up, it goes down. So on those very tight months, is this product affordable? Because the last thing they want to do is to either get into debt or miss payments. For credit reporting, does this product or this account report to just one of the credit reporting bureaus? Keep in mind that lenders are not legally required to report or to report to all three. They get to choose which ones they want to report to. Ideally, to help someone build their credit score the healthiest, we'd like them to report to all three of the major credit reporting bureaus. So what are the terms and conditions of the product? What's the interest rate? What's the annual percentage rate, the APR? What's the repayment terms? Making sure they know and understand all of the conditions of having this product and that they can manage it effectively. What are the fees, right? Fees are money out of our pocket that we prefer to stay with the people that we're working with. So is there an annual fee, a monthly serving fee, a late fee? What are all the different dings that a person could get and lose money from using this product? And then one thing that maybe sometimes I think as consumers, we may not instantly think of, those of us who have been in consumer protection, or as you are with helping those individuals, how is there some way to get customer service for this product? That's been one of the biggest issues with the Venmo, Cash App, Zelle, is that who do you call? Who do you talk to? Who do you email? Who do you chat with if you can? You know, how are they handling complaints? That's a big concern. All right, and then some just tips to know about credit building, some nuances around credit scores. So the first thing is to let people know to be careful about inquiries. So inquiries, as you saw in Amy's pie chart, is part of the person's credit score. It's what the data is used to make up. But inquiries are not legally defined by the federal legislation that is involved with credit scoring and credit reporting. The credit reporting bureaus themselves define inquiries. That to me is a little, walking in the sand. It's a little muddy, but here I'm going to give you some examples of the typically hard pull or, something that will affect someone's credit score. Applying for a credit card, right? We're literally asking for credit. That's going to be a hard inquiry. Applying for that personal loan, mortgage, car loan, any other kinds of loans. Generally speaking, getting a cell phone contract is going to be a hard inquiry, or requesting a credit line for an increase. Typically, a soft inquiry that won't actually affect someone's credit score is going to be those pre-approval card offers that you get via email, regular mail, whatever that is. Checking their own credit score. If an employer checks someone's credit report as a condition of employment, keeping in mind, I'm sure you know that in Maryland, most employers cannot do that now. There are some exemptions, but overall, employers in Maryland are not supposed to be doing that. However, if you're going to be with the federal government or different, government agencies, it may need to be done. That is still a soft inquiry. Or getting different insurance products, the car, renters, homeowners, typically that is a soft inquiry. But some of the ones that are in the gray area that we don't know about are rental applications for apartments, getting a checking or savings account, getting utilities, or verification by a financial institution, maybe a credit union, stock brokerage account, whatever. Those can go either way depending on the credit reporting bureau. So the big point that we try to talk to people about with this is just be careful how many inquiries that we're making and trying to minimize the hard inquiries that will impact our credit score. And two things I just want to point out in terms of what we call bunching hard inquiries. So if someone is shopping for a car or a mortgage, because we should be out there looking for the best interest rate we can get, all of those inquiries that you do within a short period of time, again, not a firm and fast rule, but generally speaking, 2 weeks. If someone goes shopping for a car, as Amy pointed out, that's a big need for people. If they're shopping for a car, everything within 2 weeks that they go, car dealer, bank, whatever it is, will count as one inquiry versus the multiple ones that they have made. But it has got to be within that short period of time, and it has to be within that particular credit product, the auto loan or the mortgage. So I actually had a couple who did both within a short period of time, and sure enough, they were two hard inquiries because they're different type of products. So if someone has inaccurate information after a bankruptcy or perhaps after difficulty with the loan, make sure they're checking their credit report. And if there are things on there that need to be disputed, do it. Go ahead and see if we can get those taken off and help build their credit score. A couple of things have changed recently around medical debt. So with medical debt now, if the consumer is alleging an insurance dispute, insurance should have paid it, they didn't, that collection will not be placed on their credit report. And medical debt can no longer be put on a credit report until after 180 days. You may have seen in the past with clients that medical debt is a huge issue, and every single credit report I looked at for a very long time had lots of medical debt on it. So this was sort of addressed and be able to help us understand how to help our clients with medical debt, get it off there if it shouldn't be on there, and really give them some opportunities to show that they're handling credit effectively in spite of what may have happened in the past with any kind of medical problems. So medical debt must be deleted now if it is paid in full, either by the consumer or by the insurance company. Also, some things you need to know about are the weight factors here. So more recent delinquencies, so under a year, if someone has been delinquent with a payment, those are weighted more or heavily or more negative, if you will, than older delinquencies. Same thing with an inquiry for new credit holders or someone who's rebuilding credit, those are weighted more. So if someone doesn't have credit and they're building it, they need to be very careful how many inquiries they do in a short period of time because it's going to be weighted against them more. They're viewed as riskier. And unpaid medical collections are weighted differently than unpaid non-medical, meaning that, and as an industry, the credit reporting world is starting to understand that medical collections resulted from not necessarily inability to handle credit products, but an issue that happened in the past. So non-paid, non-medical, unpaid collections are weighted more because that really relates to how we've handled credit, not what's happened in terms of our health or whether or not we had insurance. And lastly, credit cards are weighted more than installment loans. The installment loans are the equal payments, every month for 4 years, whatever it is, car loan. The credit cards actually have more impact on someone's credit score because they're considered harder to manage. It's easier to go out there and go shopping, perhaps, than to get into trouble than it is to have missed a car payment. All right, then the last thing we want to talk about the 5 aspects of things to know is that the credit scores do not consider collections that have a 0 balance. They're just actually taken out now. And you may have seen it on that chart that Amy had for credit utilization piece of it, how much credit available people have versus how much they're using. The typical rule of thumb has been don't use more than 30%. So what they're looking at now is that it's actually better to now use 10%. And in fact, the FICO score, the super FICO score, they found actually has a utilization of 6% of the available credit to us. So it's shifting a little bit in terms of the information we want to tell clients in using particularly credit cards. Where we may have said before, don't use more than 30%, the message really needs to change to put a little bit on every month and pay it right off, just so that we're not getting into debt and we have a very low utilization rate. All right, and then as a former consumer protection investigator, I cannot leave you without talking about scams. So there's a lot of scams in terms of debt repair, building debt, and we want to make sure we're telling people to be very careful. This is actually a screenshot from a debt repair company that I got online, who I will not name because it will be hard for me to say it. They literally have 3 different pricing tiers. The basic one is recommended for those who have a handful of negative items. The aggressive one, or the more money, is recommended for those who have a lot of negative items on their credit report. These companies, you may have seen in the past, they're very prolific in their advertising. They know how to target the people that we're working with, and their messages don't worry about what's happened to you in the past with credit. We can fix it. We can absolutely have negative items taken off your report, no problem. They typically had required upfront fees. They're no longer allowed to do that. For the Federal Trade Commission actually put some regulations in place on these debt settlement and debt repair companies. And we really want to make sure we're warning people about using these companies, because not only are they expensive, the main thing that I've seen they tell consumers, first message right up front, after of course they've gotten some money from them, is dispute every single thing that's on your credit report, whether you think it's accurate or not. And their strategy, first of all, is not going to be effective. And it's not worth $800. They just charge that person for that piece of advice. So really, we're trying to warn people to stay away from these type of companies, and understanding, and in our field, in our work, that we want to talk to people about building credit. That terminology and that the wording really matters, because credit repair is more and more associated with the debt settlement companies, the debt repair companies, who are not providing a good consumer service and are taking a lot of money from a lot of people to do very minimal amount of work. So we want to really frame our words in, we're going to help people build credit. We are not repairing credit, because it's more positive to say building, and repair just kind of associates us with shady companies. So with that, I'll just review the best practices about keeping it active. Maintain that mix of 3 installment or revolving credit lines at all time. Always paying on time is critical. Keeping debt balances low, and keeping up at least 6 months of credit activity on the report at all times. So with that, I will turn it back to Andrea to handle questions, and we're happy to answer any that you may have.
Thank you so much to both of you. I certainly learned so much, especially Sue. You talking about Chime. I hear advertisements for Chime on a lot of the podcasts that I listen to. So, and I had the impression that it was a bank. So very, very sneaky marketing on their part. So we have 2 questions in the chat from participant Lorna Henry. The first is, some of her clients considering bankruptcy want to know how much their credit score will drop. Obviously, that's probably subjective, but is there a rule of thumb or some kind of range that you could give someone asking that question?
So Sue, I don't know if you have a different perspective, but I will say that in the clients that I have seen, the answer to this really varies wildly depending on what their credit situation looked like immediately prior to bankruptcy. Many of the people that we help in bankruptcy are often folks that have probably missed a number of payments. They've become delinquent on a number of payments. Once you get so many of these like 30, 60, 90, 120 day like red marks on your credit, the credit score does tend to start to plummet a little bit. Because again, when you're thinking about that chart, you're thinking about like payment history being the biggest factor of your credit score. But if you were somebody who was entirely up to date, current on all of your payments, and then you filed bankruptcy, you might see a couple 100-point drop. If, on the other hand, you were wildly delinquent, you might actually see your credit score increase just a little bit after you file for bankruptcy. So it's something that can really vary quite a lot and really depends on what your credit picture looked like. And then again, I mean, everything that Sue was saying about getting access to potentially a secured card, using it just, less than 30% over time, over, 6-9 months, you can at that point be building enough credit that you might be able to apply for another credit account to be able to switch. Or many of them, if you are with them for 6 or 12 months, they'll actually switch you to a different product that has potentially lower fees. And it depends on whether the person is happy with that, whether they want to switch that product that they want to switch, or if they want to stay with it.
Yeah, and I would just add, Amy, I think you're absolutely right. What I've seen as well. I mean, one missed payment for a credit account can drop a score between 70 and 100 points. And typically, most people don't go from the 700-800 credit score to bankruptcy. there's been some hiccups along the way. So I agree with you that the credit score could drop, but it may not drop as dramatically as people might fear with the bankruptcy. And again, it can be rebuilt for sure within 2 years. And one thing to note, people may have seen, is after someone declares bankruptcy, they're often, I'm not the word victim isn't quite right. They're marketed for a lot of credit products because these companies know they can't declare bankruptcy again for a period of time. So they're like, let's go at it again and see what happens. So
Absolutely.
making sure that, people are being careful about those offers that are targeting them, because there may not be the best products for them.
Exactly.
That's a great point. My one bankruptcy client has just been getting so many invitations for car loans, which she does not need. Another question from Lorna is, do you know if landlords look more favorably on a Chapter 7 bankruptcy versus a Chapter 13 bankruptcy in the apartment renting process?
So I will say that in this one depends on if we're talking about an individual landlord versus a larger company. It does tend to be the case that individual landlords might potentially say, oh, you're not going to be able to file bankruptcy again for another 8 years. That appeals to me in terms of renting to you. And there are plenty of kind of larger companies that say, oh, you've got a recent bankruptcy. I don't necessarily want to rent to you because that sounds like you're potentially not credit worthy. But that also varies depending on who the landlord is that you're dealing with. The other thing that I'll say is that for many of the folks that I deal with, if they're potentially interested in getting into some sort of subsidized housing, particularly into senior housing, and they want to, and they've got a bunch of credit problems, there are some senior housing where their strong preference is that there is not an immediately recent bankruptcy if they're going to potentially admit you. And then there are a couple of places that say, no, we want you to clear that out. We want to see a recent bankruptcy if we're going to admit you into the senior housing. And so unfortunately, if it's like figuring out like the timing of bankruptcy, especially if the person needs to move, the person probably needs to go out, talk to some landlords, figure out based on where they want to live, who they want their landlord to be, figure out kind of what the requirements are potentially going to be in order to move, and then make a decision about when to file bankruptcy based on what's going to be most advantageous for them.
I totally agree with that. Try and get that housing first, and particularly in today's market that is so topsy-turvy with the lack of affordable rentals. It's incredibly competitive to try and get a rental at all, much less if there's anything that might cause the landlord some concerns. So for sure, get that straight beforehand. And I would say there's no firm and fast rule on landlords who say, oh, not that bankruptcy, but I'll take this bankruptcy. It really is, it varies.
I will say that the only landlords that are going to be really particular about 7s versus 13s are going to be landlords that are attorneys, because most landlords are not necessarily versed in what a 13 versus what a 7 means, in the way that many of our clients are not necessarily versed in that until we explain it to them. And so I don't think that there's necessarily a difference there in terms of like when somebody looks at it and sees a recent bankruptcy.
Thank you. I have a question about older adults and credit reports. I've heard anecdotally from at least one consumer law attorney that the credit report is just not as important to an older adult, especially when they're applying for senior housing. My first question is that, do you agree? Is that true? And does it also relate to the fact that someone who is on a fixed income can often obtain a hardship dismissal of some of the loans or the debts that they've accrued?
So I have counseled a lot of older adult clients that they don't need to put quite so much stock into what their credit score looks like as they are personally putting into what their credit score looks like. And this very much ties into everything that I was talking about at the beginning, but like people will take this number and take it as a value judgment of who they are as a human being. And there is so much racism and other BS that is tied into that, it just, you can't take that as like, well, this means I'm a bad person or this means I'm a good person, because it doesn't. But so I've talked to a lot of older adults about thinking about, you know, not necessarily saying my credit score is the one thing that tells me whether I'm a good person or not, but also, but this is often tied in with kind of talking through, like, do you have a need to potentially take out a new loan in the coming years? Are you going to need to get a car loan? Are you going to need to get a home loan? Do you need to take out additional loans? And because for many of our older adult clients, they might be, especially that are on fixed incomes, especially you know, Social Security, et cetera, they have a good and consistent income that might be potentially appealing to some credit companies where they want to market to them. But one of the things that we do with a number of our older adult clients that have usually kind of debt on the sort of smaller side is that, especially if they're being pursued by creditors, debt collectors, we'll send hardship letters on their behalf to say, you know, this person has a fixed income that you can't get to because it is exempt from, the person has collection proof income. If somebody has Social Security and only Social Security, and that's just going into their bank account is protected as long as it's got less than 2 months worth of Social Security in it. And the person and the creditor can't garnish the bank account, and they also can't garnish the Social Security directly. So it allows us to go to that creditor and say, you know, I am suggesting that you just drop this and go away because you're not going to get anything here. I've advised my client not to pay you. And that winds up being really good in terms of the person kind of retaking control over their budget and getting back on top of being able to just pay for their housing and their healthcare and their food and the things that they immediately need rather than paying debt service. This often gets tied into, you know, whether or not the person has this value judgment of who they are as a human being with their credit score. They're like, oh, but my credit score is going to drop and I'm upset about that. It's like, well, talk about that. Do you have need for credit in the coming future? And if you don't, like, let's talk about this and that. And then the other thing is, like, if everything is overwhelming and we're thinking about either doing these hardship letters or we're thinking about bankruptcy, probably at this point, the credit is not particularly good as it is, and they may not necessarily be aware of just kind of where their credit score is in comparison. So these are all sort of things that I think about and talk through with my clients when I'm talking about kind of managing debt. But Sue, do you have a kind of another perspective about?
Yeah, and I'll just sum it up because I know we don't have much time. I think your point is we need to identify what are the goals with each individual person we're working with around credit. Do they need it? Keeping in mind that credit scores are being used for things that they really shouldn't have been intended to be used for before, right? And we're fighting in the General Assembly right now, along with the Maryland Consumer Rights Coalition, to have credit scores dropped out of auto insurance pricing. It shouldn't be used for auto insurance pricing, but it is. So if someone has car insurance and they need to get a higher credit score to get a lower rate, then maybe we need to talk about working on building credit. So it really is individual on what their goals are in terms of their need for the credit score. But I really reiterate what Amy said of, like, people need to stop worrying so much about a score. It is not one score that's plastered up here. It can always improve, and it's just a piece of our worth, not even our worth. It's just a piece of information about financial health.
That's a great takeaway. I think that, you know, because of the Byzantine and oppressive and racist system that's been set up, unfortunately, credit is important for some of the goals that people have in living a happy and healthy and prosperous life, but it should not be laden with judgment. Thank you so much to both of you. Again, I just got so much out of this, and I'm sure the attendees did as well. This is recorded, and we're going to post the transcript and the slides and this video on our website in the trainings tab if anyone would like to watch it again or recommend it to your friends and your colleagues. Thank you. I hope you have a great rest of your day.
Thanks for the opportunity.
Thanks.
Thanks, everyone.